Well, good afternoon, everybody. My name is Lee Schwartz, and I'd like to welcome you to today's webinar titled The One Big Beautiful Bill, What It Means for Business Owners. We have an obscene amount of ground to cover here. So just real quick, you all might remember back in 2017, we did our best to educate our clients and really the marketplace as a whole on the Tax Cuts and Jobs Act. Fast forward a few more years, COVID hits, and we were really the leaders out there in making sure that you all were up to speed on PPP and ERC and all the other programs out there. And now here we are with the One Big Beautiful Bill Act. And just to save time, over the next hour, we'll be calling it OBA. But with this now passing, we are out in front again. Obviously, we have this webinar, but keep in mind, we're producing a lot of other content to help you. If you go to SVAaccountants.com, click on resources, and then the One Big Beautiful Bill Act hub, it's a mouthful, you will see additional information like biz tips or articles that we write, upcoming webinars that we'll have on these topics, and also links to the weekly podcast that we do called BizBeat by SVA. So far, the feedback on that is that one of the hosts is super annoying, but the content is really, really good. So we'd encourage you to check that out. So our format today, we've got several different people from our organization to talk about different aspects of OBA. 8 different presenters. The goal is to go 5 minutes per person. We will see how everybody does. Our hope is to leave some time for questions. Please chat in those questions as you have them. Hopefully we will have time. If we don't, and your question doesn't get answered, please reach out to your SVA professional if you have one. If you don't, if you're not a client, please reach out to me and I will facilitate making sure your question gets answered and we can help you in any other way that you need. So without further ado, there is a lot of ground to cover here. We're going to kick it off to Holly Eisenhower, our tax director. Holly, let's jump in.
Okay, we're going to kick things off today with some individual tax provisions and see what's changing and what is not. And overall, OBA is much more similar to the Tax Cuts and Jobs Act, which is what we are currently operating under, than what it would have reverted back to had we been in a situation where we were going back to the old law before 2018. So on our first slide here, we've got TCJA provisions that were made permanent. So a big thing pro taxpayer is we've got the individual income tax rates. So we've got 10%, 12, 22, 24, 32, 35, and 37. Very good rates pro taxpayer, and those are going to remain permanent, or at least as permanent as we can be in when we talk about the tax law. Things are constantly changing, but it's at least permanent through this presidential term. So next up, we've got a couple deductions. We've got the standard deduction and personal exemptions. The Tax Cuts and Jobs Act gave us an increased standard deduction, and that was set to revert back to a lower level. That has been made permanent, and so we're going to continue to have that higher standard deduction, simpler for taxpayers who don't have to collect the additional information needed to itemize. And that increased standard deduction had also kind of swooped in with the personal exemptions, making those essentially not needed. And so those are permanently terminated now. So moving on, we've got a couple credits. We've got the child tax credit and the other dependent credit. Those are remaining largely the same and are permanent going forward. So not going to spend a lot of time on those. Next is the alternative minimum tax. And so with the Tax Cuts and Jobs Act, we've got an increased exemption and phase out amount. That's going to be permanent and going to continue to add that simplicity to our tax law as far as not having that alternative minimum tax kick in with too many taxpayers. So a good thing for taxpayers, makes it a little bit less complicated. And last on, we've got the estate and gift tax exemption. So a lot of chatter about this in the last year. It's currently about 14 million, was set to be essentially cut in half. We now know that that's going to be permanent at 15 million going forward and indexed for inflation. Next, we have some itemized deduction items. So a big one that is changing is the state and local or SALT cap, currently at 10,000. We are going to go to 40,000 starting this year already, so for the next 5 years. It does come with a phase out though. So if you've got high income taxpayers, the phase out starts at 500,000, but you won't be phased out lower than 10,000. So an opportunity for some increased itemized deductions for folks. And so we'll be able to take that into account when we're planning for 2025 already. Next up, we have mortgage interest deduction, staying largely the same, except it's adding mortgage insurance premiums as being deductible. So we've got home equity debt and casualty loss deduction. Really not a lot changing here. The home equity debt, it's the same. If you use that money to buy, build, or substantially improve your residence, it could count as a mortgage interest. But if you use that money to buy a car, you're out of luck, at least for the home equity debt piece, and it is not deductible. Casualty loss deduction, we're going to continue with what we're currently used to, with being limited to federally declared disasters, but there is an expansion to include some state declared disasters. So we have miscellaneous itemized deductions and the P's limitation, which is kind of a throwback here. Both of those were suspended and would have been coming back in 2026. Miscellaneous itemized deductions remain permanently out of the tax law, and the P's limitations kind of suspended but then replaced with something different. So now if you are a 37% taxpayer, then you're going to have a haircut on your itemized deductions going forward. The last thing is the charitable contributions, and a couple of different things going on with charitable contributions. So if you want to make some large donations, 2025 is going to be better than 2026. But what they've added for folks that itemize is that you are going to have a 0.5% floor. So similar to medical, but if you take your contribution base or your AGI times 0.5%, you have to give to charity over that amount before it will be considered an itemized deduction. So we've got an example here, just if real simple example. If you've got somebody that gives $100,000 to charity and they're in the 37% tax bracket, let's see what happens. So we've got somebody with an AGI of $1 million, and then they were giving $100,000 to charity. Under the Tax Cuts and Jobs Act, their taxable income would be $900,000. Under OBA, they're going to have taxable income of $905,000 because they have that $5,000 haircut on their charitable contributions. So if we look at the tax savings, then under TCJA, the tax savings on that 100,000 would be 37% or 37,000. Under OBA, the tax savings is 35% of 95,000 or 3,250. So result is 3,750 less tax savings, plus you have $5,000 more taxable income, and currently not taking into the new P's limitation that's going to be starting. So a lot going on there, but just a real brief example. And next up, we have Craig Maternowski, who's going to cover some additional individual items.
Well, thank you, Holly. So to continue on with the theme of charitable contributions, there is an above the line deduction for up to $1,000 for single filers, $2,000 for married filing joint, and this is a permanent provision starting for years after 2025. And unfortunately, this does not include donations to donor advised funds. All right, moving on. Next is an enhanced deduction for seniors. So this is in addition to the already increase to the standard deduction for people over 65. So this provides a above the line deduction of $6,000 per qualifying spouse. So married filing joint, both over 65, this increases to $12,000 for you. This unfortunately phases out with modified adjusted gross income of over $75,000 for single filers and $150,000 to married filing joint. And this replaces President Trump's campaign promise of no tax on Social Security. So if you hear that, that's what this means. Okay, moving on. Auto loan interest deduction. This allows an up to $10,000 above the line deduction for personal passenger vehicles with final assembly in the USA in this time period. So it is a temporary provision for the years 2025 through 2028. And believe it or not, this includes UTVs and ATVs. There is a phase out for this as well, beginning at $100,000 for single filers and $200,000 for married filing joint. This applies to new vehicles only. So if you purchased a vehicle in 2024 and you pay interest in 2025, that interest is no good because that was purchased outside this time period. All right, this is for gambling losses. Under prior rules, gambling losses were deductible up to 100% of gambling winnings, only if you itemize your deductions. So going forward, it's going to be limited to 90% of winnings. So under the old laws, if you won $100,000 and you lost $100,000, you could offset those for zero gain. Now, if you win $100,000 but you lose $200,000, you're still going to be limited to 90% of your gambling winnings, which is $90,000. So you're going to be stuck paying tax on $10,000 no matter what. And this is permanent. Okay, we'll just briefly touch this because in an effort of time, here's some ideas that if you're going to buy a new car and maybe you're a business owner and you have the ability to manipulate your income either to push or pull income or expenses to this year or next year, you could do that planning looking at what the income limitations are. Okay, well, let's move on. Okay, no tax on tips, no tax on overtime. Too good to be true. Yeah, for some people it is. For other people, they will get some benefit. Maybe not as big as what they're hoping for, but hey, something's better than nothing, right? So this bill, I'm just going to go over how it relates to both of them first. So it provides temporary relief for the years 2025 through 2028. It's an above the line deduction, meaning you don't have to itemize. So we're going to include the gross amount income and then later subtract out the deduction. And this applies only to income taxes. So your payroll also has FICA taxes, which is that Social Security and Medicare of 7.65%. That's going to apply to the overtime as well. So you're not going to escape that. This excludes highly compensated employees, which in 2025 is wage income over 160,000. And of course, and why not, this is going to be limited by income, and that is modified adjusted gross income of 150,000 for single filers and 300 for joint filers. Okay. So as this relates specifically towards tip income, there is an up to $25,000 deduction above the line for qualifying tips. So qualifying tips are ones that are included on your W-2. They are cash or credit card. They are voluntary, and they're into an industry where tipping is customary. So think hospitality, think maybe a beauty salon. I work in professional services, so if I get a tip, then that would not be included. If I go to a restaurant and I bring a big party, I bring 15 friends and they add an 18% gratuity on the bottom of the bill, then that's mandatory. That's not voluntary. So that's kind of carved out from this. All right, overtime. So this bill creates an up to $12,500 deduction for single filers and $25,000 for married filing joint. And this applies only to the premium. So think the half portion of time and a half. So if I made $100 an hour and time and a half is $150 an hour, I would include the $150 in the gross income. I'd get a deduction for the 50, and then I would pay the FICA tax on the total 150. Okay, and then overtime for this purpose is defined under the Fair Labor Standards Act of 1938, which basically means over 40 hours. Let's move on. Okay, so what does this mean for business owners? This means that preparing your W-2s at the end of the year just got that more interesting. You're going to have to keep track of additional things, report additional things. If you have a payroll provider, they're going to do this for you. If not, maybe it's time to start thinking about that. I think at the very least, as a business owner, you're going to have to be prepared to have a discussion with clients that are with your employees that, hey, my net check after this law is the same as it was before this. And why is that? And it's because the deduction is on the personal taxes, not on the weekly paycheck. So, all right, that's all I have. I'm going to pass the baton over to Nancy. Thank you.
Thank you, Craig. So I am going to spend a few minutes going over some changes to benefits and credits related. So the first one I want to touch on briefly is this qualified bicycle commuting credit. So that used to allow employers to reimburse employees up to $20 a month for their bicycle commuting and not add it to their income. That is being permanently removed. I have actually never seen anyone take advantage of that, so I'm not sure how much of an impact this is. The next one is moving expenses. So previous to 2018, employers could reimburse employees for qualified moving expenses and not add them into their gross income. However, that was suspended from 2018 to 2025. Well, now they're permanently removing that with the exception of military. In addition, they've expanded the qualified moving expenses for military, and they are also allowing military personnel to amend their returns to pick up to reduce some of their taxable income in those years when it was suspended. Dependent care assistance, that allows for pre-tax dollars to put into a flexible spending account. That provision has been made permanent for tax years after December 31st, 25, and it has also increased that amount that's excluded from an employee's income, previously $2,500 and $5,000 to $3,750 and $7,500. And then we have educational assistance programs. So it allowed for a $5,250 exclusion from employees' income for qualified expenses, including student loans. And they have now made that permanent, and that will also be indexed for inflation going forward. So how is that going to really impact employers? That's going to give employers opportunities to really hopefully widen their employee pool by offering these additional fringe benefits to employees to better retain their existing talent and get new talent. Then I want to talk briefly about some of the additional items that are changing, and that would be the paid family and medical leave credit. So this credit was set to expire in 2025, and now they're actually taking this provision and making it permanent, and they're also allowing employers to take a credit on the insurance premiums they're paying for employees instead of just qualified expenses. And they're also reducing the eligibility, that's a tongue twister, from employees from 12 months to 6 months. And then we have the employer provided childcare credit. This is a big one. This was previously 25% of qualified childcare expenses up to $150,000. They are increasing this to 40% for a maximum credit of $500,000. And then for small businesses, they're increasing it to 50% for up to $600,000 for small businesses, and also adjusting this for inflation. And small businesses is defined at anybody less than or equal to 35 million over a 5-year period. So this is a pretty big credit and incentive for employers. And they're also allowing employers now to pool resources together, other small employers to pull those resources together to provide childcare expenses, and also utilize third-party providers for that. So again, how could this impact an employer? I think what this really does is, again, allows employers to offer these benefits to their employees And I think the hope is that it's also going to allow more parents to enter into the workforce by providing these additional credits. And with that, I am going to kick it off to Nikki, who's going to talk a little bit more about benefits on the administrative side changes. So Nikki, it's all you.
Thanks, Nancy. Just when I was starting to think the IRS, they never do anything to make our lives as accountants or business owners easier than they do it. So here they are proving me wrong. So good stuff. For 1099K reporting, it's $2,500 in 2025. It was set to go down to $600 in 2026. So under the OBA, they've increased the reporting threshold from $600 to $20,000 and over 200 transactions. So that's going to reduce the 1099Ks that get filed. 1099 NEC, non-employee compensation. So that's been $600. Same with 1099 miscellaneous. Those have both been $600 for many years. So they are increasing those to $2,000. But that's for payments made after December 31st, 2025. So we got to be careful in all of our reporting for the 2025 year will stay the $600, and then it'll go up to $2,000 for the tax year 2026, indexed for inflation. So that's all exciting stuff coming down the pike. There were changes to the employer retention credit. So previously, employers could file 2020 ERC claims through April 15th, 2024. In 2021 claims, they could make until April 15th of 2025. The IRS has a 3-year statute of limitations, except for they had already placed a 5-year limitation on Q3 and Q4 of 2021. So new with OBA, there will be no payments of the Q3 and Q4 2021 ERC claims filed after January 31st, 2024. So some people waiting on refunds might not get them through late ERC filings. They define COVID ERTC promoters and increase the penalties for them. So really trying to go after some of those fraudulent claims, and they extend the statute of limitations to 6 years for both IRS and taxpayers. So if we get notices, we have to know that, hey, they have 6 years to send those notices. So for 1099 reporting, really it just means a less burden on the business owner, increasing that filing requirement or the dollar threshold. And the ERC, some of those 2021 payments, if they haven't been received based on filing, won't be received, and the audit period is going to go to 6 years. Okay, now let's talk about some new items. So we've heard a lot about these Trump accounts. What are they? So before, we've had no government funding investment accounts for children. There's really no accounts like this that existed. No federal seed contributions to any type of funds. But now with OBA, we have an opportunity here for any children born between 2025 and 2028. They're going to get $1,000 seed money added to what is being tagged as a Trump account. There is no income limit, so just the child has to be a U.S. citizen and have a valid Social Security number. Parents can contribute to these funds as well, to this account. They can contribute up to $5,000 per year, and employers can contribute into child's account up to $2,500 per year tax-free. So that'll be interesting how that all shakes out. The accounts will not be available no matter when your child is born until starting after July of 2026. And then a child can't access those funds until they're 18. Parents can create an account for their child. If a parent does not create an account for their child, the Treasury is going to create one for them. So really, this is to help save money for your child's retirement. The final version of this bill did adhere to the IRA rules. So we will have a 10% penalty if you withdraw it before age 59 and a half. So this is really looking at a long-term savings account for your child. And then let's look at some modifications. So what did they change with this bill? So ABLE accounts, before anybody to be eligible, you had to be disabled essentially before you were age 26. The annual contributions were limited and they were tied to gift tax exclusion, and there was a savers credit available. So they expanded the eligibility. So starting as of January 1st, 2026, the eligibility is raised to 46. So that's going to get a lot more people eligible for this. Increased contribution limits were made permanent. So they made permanent the additional amount. They enhanced savers credit. So they increased it from 2,000 to 2,100. And they also allow tax-free rollovers from 529 plans. So you can take a qualified 529 plan and now roll it into an ABLE account. So that's really going to free up those funds and the usage for those funds. 529 plans, there were some differences here. So you used to be able to use your 529 plan for some K through 12 higher education. There was a $10,000 limit. So now they expand the uses of 529 plans to include certain post-secondary credentialing expenses. So I'll use an example of that in our world as, hey, we have to maintain our CPA license. So we have expenses associated with that. We could use our 529 plans for those expenses. And increases annual withdrawal on qualified K through 12 tuition to 20,000, and no other limits on other qualifying expenses. So doubled that limit for K through 12 expenses. And it's effective after the date of enactment. So it's effective right now. HSAs have a lot of changes to them. So the contributions limit was $4,300 for an individual, $8,550 for a family. They were limited to high deductible health plans, and no other healthcare coverage. So what they did also, your spouse had to have an HSA to make the HSA catch-up contribution. So what they did is they essentially doubled the contribution limits. So they added another $4,300 and another $8,550 for a family. However, that additional increased contribution limit is phased out for taxpayers whose income, their single is over 100,000 and joint is over 200,000. So need to watch that. Not everybody will get that, but a lot of taxpayers will. Expanded eligibility, so now it can include direct primary care arrangements, ACA bronze, and other plans, and seniors enrolled in Medicare Part A only. More qualified expenses, so they're increasing fitness and sports expenses, direct primary care, telehealth, and remote care used to not be included, and now it is. Catch-up rules simplified, so now both spouses 55 plus can contribute amounts, but they can both contribute it to one HSA. They don't each have to have their own HSA to do that. FSA and HRA to HSA transfer, so you can do a one-time rollover when you're switching to a high deductible health plan after a 4-year gap. Retroactive HSA setup. So a lot of times you go into a high deductible health plan, your HSA doesn't get set up right away. So there's like this gap period. They essentially said any expenses within 60 days before opening an HSA are reimbursed if coverage started. So they're trying to eliminate that gap that exists. And spouses FSA no longer blocks an HSA. So before, if you had an HSA, either you could not have an FSA, but now you can have both if the spouse's FSA doesn't disqualify you if you're each covering your own expenses. So the FSA can only be used for one taxpayer and the HSA can only be used for another taxpayer. So that was a lot of information real fast. Let's just summarize it quick. So ABLE accounts really expanded who's going to be eligible, maintain the credits, and you can roll your HSA into those accounts. So really providing a lot more flexibility. There, 529 plan expenses, so really expanded the usage of the accounts. And HSA, they did a lot there to increase the contribution limits to save tax, expanded eligibility, and qualified expenses. So now I'm going to kick it over to Ten, and he's going to talk about some more items made permanent.
Thanks, Nikki. First item that we have to discuss is bonus depreciation. So bonus depreciation under the TCJA It was 100% from 9/27/17 to 2022. Well, years 23 to 27, we started a 20% phase out. So as you can see, that would have been 0 in 2027. Well, what the new bill did was it did expand this bonus depreciation to 100%, but that is for property purchased or acquired after 1/19 of 2025. So key date there, same kind of like the TCJA, we have a separate date. Next up, we have business interest expense limitation. This does get pretty complex. So we're going to just touch on the changes since we don't have a lot of time today. But if you do have further comments, please reach out to me, your SVA advisor. We're happy to go more into detail. But what this is business interest expense was limited to 30% of adjusted taxable income. And this was new with the TCJA back in 2018. So you'll see the adjusted taxable income calculation from 2018 to 2021 was actually different than what it was from 2022 to 2024. And what we lost in 2022 to 2024 was the ability to add back depreciation and amortization to that calculation. So this was a significant disadvantage for some entities if you were in this. And what the new bill did do was it did reinstate to EBITDA, and that's no expiration date. So the depreciation amortization is back. What I do want to touch on is you might not have heard on this before, or you might haven't encountered this before, because there is a small business exemption threshold. And what that is it is a prior 3-year gross receipt test. So in 2018, it was $25 million. That changes every year for inflation. And now in 2025, we are at 31 million for that prior 3-year gross receipt test. So you might be exempt from that. As I stated before, it does get complex. There's other issues, but that's the basis of the change there. We're next going to talk about EBL, which is excess business loss deduction. And this was also new with the TCJA. So what this is this did restrict business losses that could be used to offset non-business income. And on that second bullet point in the middle, when this started in 28, any losses, so business losses, if you had them that were in excess, married filing jointly return $500,000, they were essentially suspended, put into a bucket, and they would carry over into the next year to a net operating loss to be deducted on your return. Well, now what we have is the new bill. It did make it permanent, and it retained all existing treatment and carry forward. Similar to the 163J, the business interest limitation, we do change for inflation every year. So this is $626,000 if you're married filing jointly in 2025, and it's half that if you are a single filer. So just a couple numbers to keep in mind there. Now we're next going to move into how do these items impact you? So first item, bonus depreciation. Obviously, this is a very great change for business entities and our taxpayers as well. We now can take 100% bonus depreciation. And why this is also good, because you might have some categories of property that don't qualify for 179. So that 100% bonus depreciation is available there, or if you're over the limit. Next one on business interest expense limitation. So in depreciation, amortization being added back is also a very big change, since we lost that ability in the tax years 2022 to 2024 in that adjusted taxable income calculation. And now our last one, the excess business loss deduction. So you might have seen differences that were floated out over the last month, or I should say the month before the bill was actually passed. And the House bill actually wanted to further limit these deductions. So the final bill actually is very good for taxpayers, and we're at the same to what we were prior to the new bill. That's all I have for this section. So next, I'm going to turn that over to Eric.
Thank you, Ted. We're about halfway through the seminar. So if everyone wants to take a quick breath in and out. Okay, we'll continue. In this section, we're going to talk about research and development expenses and the qualified business income. The research and development expenses always used to be expensable. In other words, you would write it off in the year that you incurred or you paid the expense. That all changed in 2017. So in 2017, under the Tax Cuts and Jobs Act, the new rule was, well, research expenses you have to deduct over 5 years instead of deducting them all in the year that you spend it. However, we're not going to kick this rule in until 2022. So in 2017, the tax law changed with the forward-looking statement that in 2022, R&D expenses would now be deductible over 5 years instead of immediate. And at some time, there was some thinking that, okay, wink, wink, nudge, nudge, we'll probably change those rules before 2022 comes. Well, 2022 came, and those changes never got enacted in spite of many attempts and bills that were floated through, perhaps because of, you might say, some partisan disagreements. Nothing really got passed at that time. And so that law continues through today. So 2022, 23, 24, companies that had R&D expenses would have to deduct those over 5 years, meaning basically they get 1/5 of the deduction in that first year that they had those R&D expenses. Big impact from a cash flow standpoint to pay tax on income that essentially wasn't there anymore because you spent it on R&D. So 2025 OBA fixes that. What it does is says starting in 2025, R&D expenses now are fully deductible again. So we're going back to what it used to be. You can spend money on R&D. When it's incurred or paid, we're going to take that deduction. And it also opened the door to look back at what has previously been undeducted so far for R&D expenses. So in 22, 23, and 24, companies that had R&D expenses would essentially say, okay, I get a deduction over 5 years and I get this small piece every year. Well, now in 2025, companies have the option on what they're going to do with those undeducted portions of R&D expenses. It matters whether a company is either 31 million or more in gross receipts or 31 million or less in gross receipts. And the benefits are the small businesses that they say that are under 31 million can actually go back in time and say, okay, I'm going to redo my tax returns for 22, 23, and 24 and do corrected tax returns to say I'm deducting all my R&D. So what does that mean? That means you're going to end up applying for refunds for those past years. Those small companies also have the option to do what big companies have the option to do. And the big companies can do one of two things. They can say, I'm going to deduct all of those previously undeducted R&D expenses in 2025, or I'm going to deduct them 50% in 25 and 50% in 26. So the block of R&D expenses I have that I have not yet been able to deduct because of those rules that kicked in 22, I can deduct those in 25, or I can split it in half, split that number in half, and deduct them in 25 and 26. That's what big businesses can do. Small businesses can do that as well. They just also have that option of going back and correcting returns and applying for refunds immediately, essentially, for those 22 through 24. Now, I say immediately, the IRS has yet to issue guidance on exactly how this is done and how to elect to go backwards in time to get those refunds. We do know that if you are going to elect that as a small business, you do have to make that election and file those returns by 1 year from the enactment date of this bill. The enactment date, if we all remember, July 4th. It's hard to forget that day. Next, I'm going to talk a little bit about the qualified business income. Just a reminder of what the qualified business income deduction is. It is a favorable rate for business income that's reported on your individual return. And that favorable rate is you get a 20% deduction from income that otherwise would have been fully taxed. So if you make $1,000 from your business, you're actually only taxed on $800 if it is qualified business income. So there's a beneficial rate. That was set to expire in 2025. So it was going to expire at the end of this year. The OBA bill then extended that permanently. And as others have said, when something's permanent in the tax code, that simply means that there's no sunset provision and it doesn't have to be renegotiated. It certainly can change, but right now, when we say it's permanent, that means it's in the bill and would have to be actively changed by a new administration if it was going to change. So what does this all mean for you? Qualified business income, you want to continue looking at that and make sure you're talking to your advisors about getting qualified business income on your return, making sure that deduction is taken. And then for R&D expenses, there's a lot to consider for businesses. You've got to look at whether you're a small business under 31 million or a large business, and then what your options are to take not only deductions this year for your R&D, but what do you do with past R&D and how can you incorporate that into your return to get the tax benefits from those? I'm going to turn it over now to Dan Glomsky.
Well, Larry, thanks. And I appreciate the breathing exercise. That was useful. So we're going to cover just a few new or enhanced items. The first one is Section 179. Section 179 is the ability to expense a purchase of a fixed assets all in 1 year. The biggest change here is the increase in the limit. It goes from 1.16 million to 2.5, and then the threshold for phase out increases to 4 million. So it really gives you the ability to probably take more Section 179, and also expands to qualified property, which includes qualified real property. This number inflation indexes going forward, so it will continue to increase and go forth. I want to expand a little bit further on to the qualified real property, because the biggest change there is really kind of the piecing out of the restaurant activity. And I have that on the next slide here that will kind of lay out what the qualified real property is. The leasehold improvements, that's kind of an extension of an existing rule. The restaurant businesses, the restaurant properties now kind of have a standalone or carve out section in the bill. This should increase the ability to claim the deduction, not meet some of the other criteria that may have prevented it in the past. So that would be something useful to look into. And then just the retail improvement property, it's just more of an expansion or safe harbor utilization there. And this again, the ability to leverage Section 179 as an option. We still can look at whether bonus depreciation might be applicable. And then I want to cover the bonus depreciation, different than what Ted discussed. So bonus depreciation options, there's a separate code section now for qualified production property, which could mean building a building for production. And that building, although you would normally depreciate over 39 years, you might have the ability to depreciate it all in 1 year or the year that it's put in service. A couple criteria there is the building has to be owned by the taxpayer, which is in most cases the entity, the business. So a lease or those types of arrangements might not work in as we kind of currently see the code section playing out. And it also has to be constructed between January 19th of 25 and January 1st of 2031. Excludes offices, lodging, parking, sales areas, R&D, software development space, all those things. So it's really kind of driven towards increasing production buildings in the United States. There's a 10-year recapture provision as part of this. So if you cease to use a building within a 10-year period, you might have to, it might force recapture. So although you may do a asset sale, that asset would of the business, you might have to pick up recapture instead of thinking you're rolling something forward. So be mindful of that, but I think this is a big opportunity for certainly manufacturers to take some additional deduction. Then the final element I have here is the meals and entertainment. And that one, nothing real special here other than it makes it permanent, moves it forward. And it's for effective after December 31st, but the reality of it is we currently have a 50% deduction. So that's why the effective date is a little odd. Entertainment expenses are still not deductible. But if you do have expenses related to a fishing vessel in Alaska or something like that, that might be something that is new for you and get some deduction eligibility there. So the takeaways on this is just to kind of bring it full circle is we have the increase for the Section 179 limits. So that will definitely give you one of those levers that you can pull, kind of evaluating your bonus depreciation options and so forth. Manufacturing facilities, if you got one or are planning to build one, you have the ability to maybe expense that and reduce your tax burden with respect to that. And then meals and entertainment are meals, not entertainment. Entertainment's still not deductible. But if you have a fishing trip in Alaska, you can look to take that deduction. So that's exciting stuff. I'm going to pass it over to the exceptional presenter, Rhett here, who will cover some modifications to note of.
Thank you, Dan. Yeah, I'll go over some modifications to certain tax provisions. First being the qualified small business stock exclusion. As you can see here, for the stock to qualify, it had to be acquired at original issuance, issued by a C corporation. The corporation has to have gross receipts equal to or less than $50 million at and before issuance. And the corporation must be engaged in an active qualified trade or business. OBA, the only change that OBA made for these requirements is the cap on gross assets has been increased from 50 million to 75 million. Next, talk about holding period requirements. So under the previous law, as long as the stock was held for 5 years, there was an exclusion of the gain that was based on the acquisition date as listed here. Going forward under OBA, it's a tiered gain exclusion now. So if you hold the stock for 3 years, you get a 50% exclusion. 4-year hold period, you get a 75% exclusion. And anything held greater than 5 years would have 100% exclusion. Next, we're going to look at the exclusion cap. Previously, the gain exclusion was limited to $10 million or 10 times the taxpayer's basis in the stock, the greater of those. OBA has increased that threshold to the greater of $15 million, which will be adjusted for inflation or still the 10 times the taxpayer's base. To keep in mind, the effective dates, these new rules apply to stock if they're issued or acquired after July 4th of this year. And also keep in mind that stock for stock exchanges and rollovers do not reset the acquisition date to get the better exclusions. Next, we'll talk about modifications with regard to qualified opportunity zones. So this was a mechanism to allow you to defer capital gains by reinvesting those gains into qualified opportunity funds or QOFs. This deferral under the old rules lasted until the earlier of that investment being sold or exchanged, or at the end of 2026, you'd have to recognize that gain. There were step-ups involved. So if you held the investment for more than 5 years, you got a 10% increase in basis. And if you held it for more than 7 years, you get an additional 5%. Now going forward under OBA, the deferral is still either the earlier of when that QOF investment is sold or exchanged, but now it's just a 5-year rolling from your investment date is when you would recognize the gain. With regard to step-ups, for investments after 12/31/2026, you still have the 10% basis step-up would apply for assets or investments held for 5 years. There's no longer a 5% step-up. However, there is a new option for a 30% step-up if held for 5 years in rural areas, which is defined as less than 50,000 people. So that enhances and gives you more benefits to go to those rural communities. Next, we'll talk about the post-investment gain exclusion. So previously under TCJA, if you held the investment for more than 10 years, any appreciation that you recognize in that QOF was entirely tax-free. Under OBA, the same thing applies. Anything over 10 years is tax-free. However, there now is a 30-year cap. So you should sell it at 30 years. Otherwise, you may have gain after that 30-year period, any appreciation beyond that. With regard to sunsets, under TCJA opportunity zones, we're going to sunset at the end of 26. Now under OBA, opportunity zones have been made permanent. Next, we're going to talk about new market tax credits. Here you'll see some of the specific credit value, the eligible areas, status, which was temporary, but has been regularly renewed by Congress, and the common project types that we see. Moving forward, not a lot of that has changed other than the status was made permanent. So there's really no sunset risk. And I've read a lot about some preferences that'll be given to rural areas, again, like the opportunity zones and mixed use projects. So now just looking forward to how these impact you and your business or you personally. With the qualified small business stock exclusion, I mean, it just gives greater flexibility. You can now exit in 3 or 4 years and still get some exclusion. There's a larger tax-free gain with that $15 million cap. More corporations will qualify, and no AMT preference. There will be no, unintended consequences of partial exclusions. With regard to opportunity zones, just gives more certainty to investors now that this is being made permanent. Get an enhanced step up for those investments in rural communities. There will be a more strict qualification process for census tracts. And we do see, unfortunately, that there's going to be more reporting requirements in the future with substantial penalties for noncompliance. So something to keep in mind. With regard to new market tax credits, again, added certainty now that it's permanent. Potentially more capital bringing into deals based on the permanent credits and the potential for stacking with opportunity zones or LIHTC, which the OBB encourages, and then just enhance rural access. With some of these credits, it might give more opportunities that didn't exist under previous law. And then lastly, I haven't touched on it previously. I want to talk about international tax provisions. High level, we're going to see a higher effective tax rate on foreign income just because they reduced certain deductions. There could be potential compliance relief under the CPC. And as of today, there's been no new retaliatory tax regimes that have been placed into law. So that's all good news. Next, Abby Holton will cover some additional business tax provisions.
Yeah, so we just wanted to briefly touch on some of the impacts on the state side of things. So with the Tax Cuts and Jobs Act, the states responded to that state and local tax limitation of $10,000 by implementing what is called the pass-through entity tax. And this allows S corporation and partnership owners to elect to pay that state income tax at the entity level. It is then deducted and passed through at the lower income is passed through to the owners. So this was a big benefit that came out, the workaround, and the One Big Beautiful Bill also allows for this to continue on. You may have heard that the House version of the bill jeopardized the benefit of this option, but the Senate bill that passed is much more favorable, so things can continue on this way. One item to note here is a few of these states are set to expire at the end of December 2025. Here, California actually just recently extended theirs, so they are now extended for 5 more years to 2030. So moving on to some of the states' conformity to the Internal Revenue Code will be different than the federal law that we've covered today. So we're not exactly sure how all of the states are going to decide to capture these changes. So that's something that we want to monitor. And if you are operating in multiple states, really encourage you to stay in contact with your SVA representative, or you can reach out to me and we can help you monitor those changes as states may decide to adjust these, and a lot of their legislative sessions have already passed, so there may be a delay. Moving on, some of the benefits here is if you are a high income individual or a business owner with profitable pass-through entities operating in multiple states, the pass-through entity tax elections are still beneficial for you. And moving on to the state conformity, as I mentioned, this is going to need to be analyzed at a state-by-state basis. So really encourage you to stay in contact with your SVA representative to assist you through that if you operate in multiple states. Moving on, we're just going to briefly touch on some energy provisions. So there were some significant changes under the OBA with energy provisions that consisted of accelerating the terminations for various green energy credits. Many of those were previously implemented under the Inflation Reduction Act. So a lot of these are just moving up the termination dates And as you'll see here, energy efficient commercial buildings, that is terminated as of June 30th, 2026. The home energy credits, that will be terminated at the end of 2025. Moving on to a few more to touch on. Some of the most talked about items that I've heard are the EV vehicle credits. So those are going away as of September 30th, 2025. So you'll just want to keep that in mind because that's coming up very quickly. And then some of the commercial clean vehicle credits as well. So that applies both to individuals and maybe commercial or business entities. And moving on, well, the last two we'll cover here is the alternative fuel refueling. A lot of this, like EV chargers fall under this. That ends June 30th. And then the clean energy production and investment for wind and solar facilities that is placed in service after 12/31/27. And then all other facilities will be until 2032. Just moving on to wrap this section up. So as you've seen a lot of these times, terminations have moved up. So just make sure that you are monitoring your contracts to align with those earlier phase outs and credit terminations. There are some new restrictions for foreign entities. So really encourage you to review organizational charts just to be aware if there's any foreign investment there, because that could make the credit ineligible. And transferability does remain until the underlying credits are phased out. So just something that I wanted to point out. So be aware of those phase out termination dates. And that'll wrap up my section. Back to Lee.
Thank you, Abby. All right, so before we started, everybody, we had 9 presenters, and I had the over under on us going over it. Like there was like a 98% chance we were going to go over an hour. Somehow, you guys packed all that information into just under a full hour. That was a lot of information. We've had some questions come in. I don't know that we'll have a chance to get to those. Some of them are very specific. Some have already been answered in the chat. But I just want to ask this one question. And Eric, I might throw this to you if you're ready for it. But there's a lot here. This is going to affect everybody a little bit differently. But when you look at this holistically, what are the real big chunky things? Like what are the things where you're like, oh, this is the one that, maybe not the one, but these are the things that are really the huge takeaways here?
Yeah, I guess I look at a couple different things. One is for businesses. I think R&D, interest expense, bonus depreciation, Section 179, a lot of these rules got friendlier for you. So from a business standpoint, I think very enjoyable as far as this bill. From an individual standpoint, for the most part, it's a lot of good things. There's a couple of, I think, tax increases on the top end that are not being advertised, but are there with some limitations on deductions. But I think if you consider the Trump promises of no tax on overtime, no tax on tips, no tax on Social Security, those are kind of all half filled in. You got the no tax on overtime and the no tax on tips, but there's limitations there. There is still tax on Social Security. So there's an additional deduction for seniors, but there's still a tax liability that could apply to your Social Security. So I think that's a little more mixed, but businesses definitely got a good end of this. And then, I think what's important now is how does it affect you? And as you gather all this information in and go to your sources to get it, you want to start planning then for the year. And this came way earlier than I expected. I will give this administration some credit for pounding a bill through that it almost seems like record time related to other presidential campaigns. So this came through really well, really fast. But what it does is it gives you time now to look from now through the end of the year as far as, hey, what provisions are in place that affect me? What do I have to get ready for? And, I think that timing will be beneficial. Have 6 months to talk about it or 5 months to talk about it instead of, 1 or 2, which is what has been left before when bills have passed.
Right. I know our team is really thankful that we'll have a little bit more time, that we don't have to condense it all into a couple months. But all 9 presenters, great job. So much information. Thank you for digging into your parts of the bill really deeply so you could share this information with our audience. And I just want to, as we wrap up, I just want to let everybody know and remind everybody you can go to svaccountants.com, click on resources and the One Big Beautiful Bill Act hub. You're going to see additional information there like biz tips, any upcoming webinars we have scheduled. There's links to our podcast, the Biz Beat by SVA. Each week we're spending 15 to 20 minutes talking about different aspects of this bill. We also answer some mailbag questions. So subscribe on YouTube, Apple Podcasts, and Spotify. If you're a part of an organization that has a membership group that would be interested in understanding how this bill is going to affect them, we would be happy to present a customized webinar or an in-person presentation. And please reach out to me if you're interested in that. And also look, if there are topics that you're interested in for future webinars, reach out to us too. We want to incorporate what you want to hear. But just an overall reminder, this was designed to be a general overview of how this bill might affect you. But your business is unique. Your structure, your size, your industry, lots of other factors are going to determine how this is going to affect you. And all that is to say that you need to have a strong tax and business advisor to help you navigate what's best for you and your business. And guess what? That's where SVA comes in. So if you haven't been doing proactive tax planning in the past, now is the time. We are only a phone call away. So if you are a client, reach out to your SVA professional. If you are not a client, reach out to me and we can talk about how to make you one. Really excited to bring additional information to you. Thanks for attending today. And everybody, hope you have a great rest of your afternoon. Bye-bye.